And we're live.
Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissono with Kevin Casey, and today we are joined by the amazing Bill Bodnar. How are you today?
I'm terrific. Thanks for having me.
Terrific. Okay, I'm going to do something I don't typically do, which is I want to start with your background a little bit.
Mm.
Why why are we so happy to have you with us today? I mean, because really in 1993, you were a golf professional with the New Jersey PGA. I thought that was very interesting. And you have had something to do with producing Rock of Ages on Broadway. So tell us the mortgage part and why you are going to be such a little wealth of information about the economy today.
Well, I've always been a student of the markets. And, when I was a golf pro, no one ever enters the mortgage business, comes out of the womb and says, hey, I'm going to be in the mortgage business. And I'm another one of those stories. So, I got to meet, Barry B. We became really good friends. I helped him with his golf game, and he started Mortgage Market Guide and it presented, 25 years ago right now. An unbelievable opportunity. I remember rates crossing from 6% to 5%. And that was like, oh my God. And so we lived through all that crazy time. It was a great moment in time, but that's how I got into the mortgage space. And, been a student in the markets forever, even in advance of that, day trading and all that stuff. And, I look at where, and when you look at the markets, Audrey, and what we do here, like at MMG is kind of, look at all the data and then you look at the charts. And, back then we talked about Japanese candlestick charts. And it's so funny, I got to meet the guy that really brought them to United States, a guy by the name of Steve Nissen. And I remember sitting at the Manhattan Club in Manhattan with a bunch of day traders. And this is 2001, right? And I was fascinated. Like no one was talking about Japanese candlestick charts. And I ended up learning that he lived about 15 minutes from me. And I ended up doing his mortgage. One of the few mortgages that I did. I did a little mortgage business, but I did like the grandfather of Japanese candlesticks. I did his mortgage, and he lives right here in New Jersey. So yeah, it's been a hell of a ride, and like you folks, it's had its trials and tribulations.
Yes,
Yes, it
we've
does.
discussed ad nauseum that there is, they keep lamenting, where's normal? When is it going to get back to normal? And I maintain there is no normal. It is always crazy. We don't need to do drugs or gamble. We are in the mortgage business. So every day we wake up and we're gambling with our income and the market. And all we need to do is stay focused and steady. With that being said, Kevin, we have a live NMLS class coming up this week. It's on Thursday
Yes, we
in
do.
San Bruno. And that's if you want to just knock it all out in one day and know when you left that NMLS will not be reviewing the video of your attendance at a online NMLS class and deciding that you weren't paying enough attention and telling you that you are
That's a that's a big thing right now. I was talking to people who've done it. Oh, I got it done. I got it out of the way. Oh, wait, and I got it done really fast. I'm like, they review the videos and they see how long you were on it. And if you weren't there for the 6 hours and 40 minutes that are the minimum required to be on there, you get your credit wiped out. And God help you if they do it after the year starts, because then you're really in trouble. So.
Yeah. I mean, not to scare the crap out of you or anything, but if you are interested in doing a live class, we are doing them up and down the state of California and anywhere else that somebody contacts us and lets us know that they'd like us to teach them. So look for the video. Kevin has been very faithful about sending them out recently, saying where they are, when they are, and we keep adding different dates and places. So keep your eyes peeled, kids. In other news, Thursday, we have PPI. Friday, we have retail sales. And as always, we are, well, not always, not historically always, but now we're part of the Crispin Marketplace group, Crispin Commentary group. So make sure you're checking out their marketplace. They have a lot of really good information. They're really working on being the one-stop shop for where you go to find out what's going on, what you need, look for resources, etc. So, with all that being said, where do we start? I mean, my list is so long and so deep, it's crazy. Why don't we start with CPI since that came out this morning, Consumer Price Index. So one of the main drivers for inflation information and one of the things that the Fed looks at are the inflation numbers. So Bill, why don't you walk us through today's CPI report where we
Yeah.
ended?
Yeah. I mean, a great point, Audrey. I think CPI is probably the biggest interest rate moving report, typically, because remember that there's multiple gauges of inflation, and CPI, the consumer price index, comes out in the middle of the month, whereas core PCE, the Fed's favored gauge, comes really at the last day of the month. So it's almost kind of like a precursor to what that core PCE is going to be. And so with that said, the headline number came in slightly below. Thank God energy's low, so that's a good thing. We've seen it oil like $63 a barrel, and that's a very big. I think for everybody on the call and listening to the replay, if you track oil and 30-year mortgage rates, they ebb and flow together. It's remarkable.
They do.
And in fact, last year, they both hit 2024 lows like within the same 24-hour period. Like in the middle of September, oil hit like $61 a barrel, $66 a barrel, and mortgage rates hit their low. And then this year, right around January 15th, I think oil hit like $81 a barrel, 30-year mortgage rates peaked, and they just declined all month. So you really do have to watch oil. And so that was a really good nugget, and I think it's disinflation. On the other side, you had the core number come in a skosh hotter, and a lot of it has to do with our world, shelter. And, there's a lot of head scratching within that number. First off, housing or shelter makes up 42% of core CPI. That's a big number. So that means the rest of the basket of inflation is pretty anemic, right? There's not a lot of heavy inflation outside of shelter. And I still question whether shelter is getting counted right. There's lagging indicators, rents are annualized, right? But you have to tabulate them. If they don't answer, you kind of guess. So there's a lot of noise, and obviously we probably talk about it. There's been a lot of noise in some of the data, and there have been some repercussions, right, with the Bureau of Labor Statistics. But the inflation story, long answer to your short question, it's disinflating, it's going slower. Energy is a gigantic component of it, and I don't see a world where energy is going to get run away from us and start causing a problem. So I think it's better days ahead as it relates to inflation. And lastly, on the tariff side, there wasn't a lot of tariff, as folks looking for it and all over the place. There just wasn't a lot of tariff type of inflation, at least not yet, which is a good thing.
Yeah, fingers crossed on that. As far as gas prices go, yes, it is nice. I'm still paying $4.87 a gallon for gas in my local Chevron station. And I am a little bitter about that every time I hear about gas prices around the country, but I'll let that go. I'm just glad it's not 6 something a gallon anymore. So that's
Right.
blessed relief. But yeah, the disparity or the discrepancy between locales as far as gas prices is astonishing.
Yeah.
I actually had something interesting pop up this week regarding inflation, and that was I was pre-approving a client for a purchase, and when I did the math, it turned out that her new mortgage payments would actually be less than her current rent payment. And I was like, wow, oh man, I haven't seen this happen in a long time.
Isn't that a good story?
Yeah, that's,
And also, I mean, if you really look at it, because Kevin was telling me about this and mentioned that it was what, $8 a month or something like that better. But if you include the fact that principal is being paid every month versus,
Mhm.
seeing your rent payment down
And
to
there's an interest deduction.
it just
Yeah.
the whole dynamic of everything. So it is worthwhile to run those numbers for sure and
Yeah.
make sure that your clients are really aware of what the real situation is, right? How happy was
Yeah.
she? Were they?
Well, she didn't get the place, unfortunately.
Oh,
They are still negotiating because they
Okay,
didn't get any other offers.
okay, that's a really interesting point, Kevin, because in the last couple weeks, I've had one borrower who was up against 4 offers. I had another borrower who was up against 14 offers. Yet you hear these pundits on the news stations, and I see it all the time on LinkedIn talking about how crappy the market is and there are no buyers and blah, blah, blah. And the
Well,
sky.
in her particular case, there was no other offers, and she offered full price, but they decided they wanted more. But they have yet to get any other offers. And she did not know when she made the offer, because she made the offer sight unseen. She only made it off the photos on the internet. It's
wow.
tenant occupied, not disclosed. And now she's like, I offered too much. I didn't know it was tenant occupied. That's another expense I have to deal with. I'm going to come back lower now.
Well, tell them why, Kevin. Tell them why that tenant occupancy is a big
Oh,
deal.
I love tenant occupied places because well, especially in California, you got to hire an attorney to get rid of the tenant. So there's extra costs, and a tenant occupied place, once the tenant is vacated, is the property is then delivered empty, just like the house is beautifully staged. When you buy it, all the staging is removed and it's not so beautifully presented. It's delivered vacant, just like a rental property would be. So you're buying a discount because of just how it's presented. Because tenants don't take care of houses. You come into a house, it's got their clutter in there, it doesn't look good, things aren't so clean, and it doesn't show well. Versus the house that's fully beautifully staged and all the gorgeous artwork. I can't tell you how many times I've done open houses and the people are coming, oh my God, the artwork is so beautiful. Like, yeah, it doesn't stay with the property. You're getting a blank, empty room when you buy the place. So
Hmm.
it's
And
interesting how people perceive the stage and how great those are, but it definitely drives the price up because people will bid for those. That's when you get the multiple offers on the stage places.
I want to give people color on what that extra expense you referred to might look like, because I have reached
Oh, I have seen
the
10
last
to 20%
week.
swings.
Kevin,
Yes.
I've gotten 2 phone calls in the last few weeks where one person was being paid $60,000 to get out of the property as a tenant.
Mhm.
The borrower was being paid
What?
$100 to.
Yep.
we
I've seen it.
we have state,
If it's rent control.
yeah, and then some cities have worse rent control. So I mean, when you're a landlord, it puts a whole different thing, whole different everything on everything.
Yeah.
Wow.
Welcome to rent control.
Well,
Yep.
they're going to try to impose that north of us here in New York City. We're going to see how that plays out.
You might
Hmm.
have any ability to fight that, but I would if I were you, because it really does
I
impact.
live in New Jersey. I think it's only going to help our property values.
Yeah, because some
Yeah.
people are told don't
Crazy.
buy in that city because their rent control is so bad. I mean,
Oh,
there are places where it's like they own you once that goes into effect. So
Hmm.
yeah, crazy.
And the crazy part is what it ends up doing is it limits people putting houses up for rent.
of
People are
course.
hesitant to give away that right. Is now they can't take it back. Can't. Oh wait, I want to rent it to somebody else. No, you're stuck with it, and it drives up the cost of rents because you get all these places that are locked in at low rents. Those tenants don't move, and
Yep.
now all the remaining places there's fewer of them, so therefore that drives up the rents on them. So it's
Absolutely.
just one of those things.
It's a bad.
But then the rest of that is it also really hurts the tenants ultimately, because one of the phone calls I got was from a woman in her 70s who was being, I mean, somehow I think the seller was selling finally, and there was going to be an owner occupant moving in. And here is a 70-something-year-old woman. You have to pay taxes on that money, just for the record. So you're not getting 100 grand or 60, you're getting, some portion of it after you've paid taxes, and she couldn't afford to buy a place, and now she is going to have to relocate and find a new life at that stage. And I just thought it was just so sad. So
Mm.
anyway, okay, well,
Yeah,
on that.
no. Yeah, we had someone comment about Airbnb also coming into play because that's what a lot of people will go for is, well, if I can't because of rent control, all this Airbnb it. And I have an Airbnb and one of my guests wanted to rent it out like ongoing as a regular thing. I'm like, why would I do that? And they're like, well, because I'll give you a steady rent. I'm like, you're not going to match what I make on Airbnb because you're thinking she was literally renting Monday through one Thursday or something like that. And I go, I don't charge that much for Tuesdays to Thursdays because it's the weekends I make my money on the Airbnb. And I make this. You can rent something cheaper than that. And I don't want to rent to someone for 30 days because then you'll have more rights than I will. And I don't want to give up my rights to do whatever I want to do because I have friends that come to town and I put them up on my Airbnb.
Yeah. And also, you don't even have to be on the lease to be entitled to these tenants' rights, Bill.
Hmm.
We have moved in, and anyway, so that's our problem, not everyone's problem. So if
Yeah.
you're in Florida right now, you're congratulating yourself, and between my gas price and our rent control, which at a state level is not terrible, but it's still, it is all bad for the tenants, for the owners. It's bad for everyone.
It's
So
all because we have nice weather.
we have great weather.
You do have great weather.
Some of us, depending on which side of the bay you're on. So, okay, so let's talk about, since we were talking about CPI, let's talk about BLS in general, since a lot of people understand that BLS, Bureau of Labor Statistics, is in charge of the job numbers, but a lot of people aren't aware that they're also generating inflation numbers for us and a lot of other reports too. And they have obviously, I would imagine most people know, have come under a lot of fire recently, and their head of the BLS was fired last week because the job numbers came in. And I think it's funny because we have been lamenting the job numbers for months, thinking they were completely out of whack, way too high. There's no way we're having that many job creations. The discrepancy between BLS and ADP it was stark. We couldn't understand it. And so we thought those numbers were total crap, right? We didn't believe in this.
That's right.
The second the numbers come in and there were hardly any job creations, and now it looks terrible. And then we're cheering, right? Oh, yay, finally they got it right. Okay, so I don't know where right is. I think that when QCEW comes out with their numbers at the end of the year, that's when we know it's right. And Bill, I'm waiting, you're gonna have a chance to tell me whether I'm right or wrong. So a new head of the BLS has been nominated, E.J. Antoni.
Mm-hmm.
I'm curious to know what your thoughts are on what will they be doing. He's been very critical of BLS in the past. And
Yeah.
so, I mean, do you think they're going to change? And my understanding is they changed the way they tabulated numbers in June already. And so what's going to happen? Thoughts?
Well, the BLS has been challenged now for a couple of years, not just this year, really for a couple of years. And there's always noise. I think where I land on it, again, there's enough politics and BS to go around. I land on it where, if the three of us ran the BLS and we produce jobs numbers that the Fed has to rely on. I mean, they're sitting on their hands and not cutting rates because the labor market hasn't shown any weakness. And you put out that report that is 90% off, you got to get fired. I mean, in the private sector, you don't have a job, period. I mean, can you imagine? There is not a company that's like your job. You have one job. And if you have a problem with the data, you have the problem, you raise your hand, you fix it. You can't put out a report that's off by 90%. And so I don't know what he's going to do. That you hear people both sides, and I, cutting through the noise, I hear that people aren't, responding to the surveys. Surveys suck. They're like polls, right? They're useless. Soft data is a joke. Soft data is a joke. Even on the consumer sentiment numbers, they're wildly optimistic, wildly negative, depending on the flavor of the month. They got to get something better. And, we have AI, we have quantum computing. I mean, don't tell me we can't figure it out. So I think something's going to happen. Is it going to happen this month? No. But the data has been bad. And what makes it really awful, Audrey, is that our Fed is driving the most important interest rate in the planet based on that. Half the mandate. And by the way, they also produced CPI that came out today. So got to get the data right, because if monetary policy is driven off that, we got to fix it. I had a suggestion. I mean, the PCE, core PCE comes out on the last day of the month for the previous month. So, the end of August, we're going to get a July number. Why don't you just put the jobs report there? Who cares? Who cares why is there this rush on the first Friday of the month to produce a jobs report, which is obviously just a piece of garbage? I mean, it's really a useless number at the beginning of the month, and it's become even more useless. And I think some of the noise, to the BLS's credit, has been caused from the pandemic. You have, businesses, removed and created. So there's a lot of noise, but we got to factor all that in. Anyway, long story short, we need better methodology. We need more modern. It's got to be crisp. I see the other things. You look at some of the other Fed places like Cleveland Fed Nowcasting. They try to tell you where inflation is in real time, right? GDP Now tries to tell you where GDP is now. Well, why don't we create one for the labor market so there's no big mystery, right?
Yeah.
It can't be that hard. I mean, there's so many payroll companies out there. We get the ADP numbers, and all they have to do is do a weekly report. How many people received a check last week? How many of those people received a check this week? How many of those people did not receive a check this week? And how many new people came into the market between this week? And they would happen instantaneously. And then, okay, so there's several payroll companies. bring them all into the mix, because one of the weaknesses of ADP is if they had like an account for IBM and they lost IBM's account, that would make their numbers throw off, right? But if you have all of the payroll companies required to report these numbers on a regular basis, now at least you get the people that are getting salaries on the data. Now there are
Right.
other people self-employed, other things, but you can, as if you had that data as your nice stat, because that's a good flow of information. You don't need
Yeah. I mean,
everybody's job because it's a survey. And if you're surveying just that part of it, you know how the economy's doing in real time.
yeah.
That's
I
neat.
read I thought the BBC did a really good job of breaking down how it works. It helped me understand
Hmm.
a little more. So they said that the jobs report is based on two surveys, one that collects data from about 60,000 households and another 121,000 public and private sector employers. The estimate from the employers is called the establishment survey, and they think it's more reliable than the household survey because it is larger. The this is from them. A majority of the responses come from large firms typically enrolled in a program that automatically submits their employment information. BLS staff also run web surveys and telephone interviews. Well, we all know, like I don't answer random phone calls anymore. And it sounds like they have a certain group of people they are sending to. It says the Bureau updates the figures in 2 months following initial monthly estimate as more responses come in. It also recalculates the numbers annually to incorporate data from unemployment insurance tax records in the records going back to 1979. So this, because I have been screaming about this for sure since at least the 90s when I started becoming aware of the impact of the jobs report on mortgage rates. The average monthly change to the job figures, either up or down, is 57,000 per month. That goes back to 1979. That is
Well,
astounding. But they also noted that the revisions get bigger when we have economic turmoil. So, do we have any
Price.
kids? I would say we do. They also noted that other central banks around the world are having the same issue because the response rates have dropped so significantly.
mm,
And so there are concerns about the reliability of the data. So, for example, the response rate for the establishment survey was less than 43% in March, compared with more than 60% a decade earlier, which, by the way, in my mind, is not a very high number. So, if
no.
people who are supposed to be responding to the survey that is driving economic policy in the United States and around the world, maybe there should be some requirement that they respond. I don't know. What do you think? So the response to the labor force survey has fallen to about 20% in the United Kingdom. So everyone is really struggling with this. And so again, my question is the markets should know this, the markets. Why do they put so much weight on them? And why is our Fed relying on numbers that are often, I mean, they're just coming out of
Inaccurate.
So on the Fed, it's a head scratcher because there's so much data that they can look at. They're looking at. I'm always reminded. By the way, next week's a big week, right? You got the Jackson Hole. So
right,
last Jackson Hole last year, he said something to the effect of any further cooling in the labor market would be unwelcome.
right.
That's the case, and the numbers aren't. Jazz at 57 is on average for the last whatever, and to come in, absolutely not even close. That's tough because you don't want to fall behind on unemployment. So where I land there is, well, what about the future indicators, right? Continuing claims, initial jobless claims, continuing claims. They're pretty accurate. It's how many people are continuing to receive unemployment beyond a week. If those numbers are ticking up, unemployment is going in the wrong direction, and you got to get out in front of it. And so, what are you looking at, right? I don't know. They don't tell us. In fact, that's another problem that we probably have with the Fed. We can go on the Fed for 3 hours. Besides the fact that they're not looking, is it forward-looking data? Is it backward-looking data? How about having 12 or 15 folks grab a mic and all saying something different? It's like, can't we all just get along and agree on something? I mean, Austin Goolsbee has never seen a mic he didn't like. And some of the stuff he says is wild. And it's like, well, wait a second. He was like, hike, hike, hike. And all of a sudden, well, if the tariffs aren't there, then now we're on the golden path. Well, what is it? So it's really noisy. I think that's going to change too next year with a new Fed chair. I think we get to a spot, we go old school, Audrey. We go back to the days of we're just going to hike and cut and you're going to deal with it. I hope so. Right? Don't try to tell me where you're going, because the market, we have lived through so much uncertainty and volatility in the mortgage market simply because Fed folks are speaking all the time. Shut them up. There's a quiet period before the Fed meeting. We should have a quiet period all the time. I think we'd be better for it.
Do you think that so interesting thought? Because I've also heard people say, well, at least they give us a heads up before something's going to go down, right? But I agree that there's no consensus, and all of the yes, no, yes, up, down,
It's all over.
it's disruptive. And
Who's
also,
dissenting? Who's not dissenting? What is this? We could do it. We could. They're great at speaking out of both sides of their mouth. Well, we could do it if this happens. That's not helping me. You're better off not saying a word. The markets will figure it out. The bond market will figure it out. It'll know exactly where things are, right? Bond market's worried about a lot of things, not necessarily every time Fed officials.
So, Bill, is your name in the hat for Fed chair coming up?
I don't know. I don't really care. You know, there. It doesn't. You know.
let's talk about that for a minute.
You know, on the Fed. You know, on the Fed. I'm not a fan of the political getting in the middle of it.
I am not either.
No, it's no good. At the same time, I think there's a lot of pressure, like on both sides, and you don't want to think that the Fed is being politicized. But then as time goes on, you ask, well, what the heck did you cut rates for? Right? It's like inflation's come down. You know, when you cut last year a couple of times in the middle of a cycle, it didn't smell funny. You know, I'm really not a fan of any of the politics within the Fed whatsoever.
I don't either. I hate it. And so the president has appointed Stephen Mirren, who's currently the chair of the Council of Economic Advisors, to replace the Fed governor who's leaving. And
Right.
so I'm just curious, I wonder whether he'll be confirmed before the next board meeting or the next Fed meeting on September 17th. I mean, because obviously they'll want his vote in there, right? And
Yeah.
will they sway the rest of them? There are 12 Fed governors at the moment. Only 3 of them are even indicating that they want to cut. And of those 3, one of them, who's Goolsbee, he had talked about wanting to cut, but then he didn't dissent at the last meeting. So it's all, I mean, are you voting the way your friend next to you is voting? How's that go?
I think the dissenters have once you start seeing dissenters, Audrey, like 2, we haven't seen it in 30 years. The tide's coming, and you know you're seeing Goolsbee crack saying, "Well, the tariff inflation's not there. It's probably time to go," and others are saying it. So, you know, I think we're at 95% chance to cut in September. I can't even imagine it not happening in September. But you know, unless some number comes out that really does change everything. It wasn't in the inflation numbers, and the labor market numbers are really fragile, you know. And you know, on the labor market side, I think where monetary policy has to work with fiscal policy is, you know, we came into this year, you know, new president, new administration, and then you have to get fiscal policy in place. Well, a bill, well, it doesn't make a difference if you like it or not, but there wasn't a big, beautiful bill signed until what, 30 days ago? And so if you're a leader, you're a CFO, you're a leader of a company, you don't hire, you don't fire, you just kind of sit on your hands. And so now you hope the economy holds it together until new fiscal policy takes place. Same thing with tariffs. I mean, there's a lot of lunacy about chaos, but even with all that said and gone, you know, we're getting towards the end of that kind of uncertainty, which I think is a good thing for the economy. But at the same time, you can't have the economy fall apart just as fiscal policy is starting to, you know, take roots.
So here's the real question, Bill. So I still have PTSD from last fall when they cut the rates, and the Fed funds rate and the mortgage rates went through the roof, and it didn't come down for a while. So
That's right.
when they do cut in September, I mean, what do we expect? I mean, do we just buckle up and hope for the best? I guess so, right?
Well, it's actually a perfect time to ask that question, because if you look at what the 10-year note's doing, and here I am looking at it on TV at 430, and that's after you're now getting a very elevated chance of Fed rate cut in September. So does the bond market, the long end of the bond market, start saying, you know, we back to the same movie last September? We start getting cuts and longer term rates get higher? We're gonna have to watch it. But part of the interest rate pressure that we're having today in the United States is not just the cut and the, you know, the idea, because the inflation, I don't think the bond market is necessarily worried about it. It's about that, hey, we're going to cut and we're going to stoke it in the future, which is the bond market looking forward. The other problem that the bond market has in our world is global debt. The debt here in the United States and debt around. Like in Germany, they hit like a 15-year high on their 30-year Bund. And if those booms go higher, remember, they have their own version of a big, beautiful bill, and they're not growing the way we are. They're kind of limping along, and I don't know how they're going to pay for this crap. And so if the bond market punishes them, it puts punishment on everybody, because as their yields rise, it puts pressure, tide rises all boats. So I'm watching that story, and it's the highest again since 2011. It's getting a little crazy there. And same thing in Japan. Japan's yields are at 30-year highs on long-term bonds.
Well,
Yeah.
I'm not looking at yields, but I was looking at interest rates around the world, and we're at the central banks of around the world. We're at 4.33. We
Yeah.
have the UK 4%, EU 2.15%,
Oh, yeah.
Brazil's at 15%, Russia's at 18%, and Turkey, you ready? Hang on, kiddies, 43%.
That's
You want to feel better about where we are today, that should do it.
that's crappy fiscal policy. That is awful.
Yeah.
They have to have inflation coming out of their eyeballs.
Buy anything. I mean, that is nutsola. We were complaining about eggs a year ago or whenever that was. I mean, that is crazyville. But in your opinion, we'll just skip do you think we should have cut sooner, and we'll go right to how many do you think we should have the rest of the year? Do you have an opinion about that?
The market is pricing in a 50% chance of 3 rate cuts. By the way, Fed funds futures have not been right. The Fed has been in one of these rare cycles over the last few years. The Fed, there's a joke, things you could bet on: death, taxes, and the dot plot being wrong. Well, the dot plot has been kind of right, whether we like it or not. It's been suckful, but it's been right. And so they definitely cut in September, and they're probably going to sneak one more in, and then we see what happens after that. I think the market, the long end of the market, could certainly influence that, Audrey, right? If the bond market kind of rolls over and yields spike again, we're going to have this cutting PTSD, as you said. So it's going to be an interesting moment in time. Where I look at now is more of the fiscal policy, and if the bond market likes it. I always joke, and I wish this would have happened. I said back at the beginning of the year, when Powell was getting attacked by Trump, at that time, Besson pulled him aside and said, "Hey, dude, cut it out. You can't influence mortgage rates and affordability in housing. We got to focus on a 10-year note." And so when Besson put a target on a 10-year note, I was very hopeful. And then things quieted down. And then he's talking about lowering the rate. And I'm like, well, I don't know that I really need that. I'm more important. Like, the bond market has to feel really good about how we're managing our debt and our deficits, and we're growing. Like, growth doesn't mean you have to have inflation. Growth means we're producing more, and we're able to, because inflation is just too much money chasing too few goods. If you're producing a lot of goods and people have money in their pocket and they're feeling good, it's a good story, and you can pay down the debt. That's why you need growth. You need growth to pay down the debt.
Right.
Yeah, I hope that's where it goes, because if that happens, Powell is really, any Fed person is non-existent, right? It's not really important what they do for us in mortgage. It's much more driven by fiscal policy.
So let's talk about mortgage spreads for a minute, because today it was interesting to see green in both the 10-year and bonds, which often they will move in opposite directions. Can you just address that and what's been going on with the spread?
Well, the spreads have come down over the last couple of years. They got crazy, right? A few years ago, they were 300 basis points. They've gotten narrower. I think mortgage has become more attractive, a little less supply, less refinance risk. I mean, they've been attractive. I think one of the things that could be really beneficial for us, and a wild card where we get more, compression of those spreads, is this idea, and it's coming, that this enhanced leverage ratio, right? This ESLR, right? And so if you're familiar with this, right now the banks have certain lending capabilities based on, on what they have on the books, what they can lend against. And a chunk of that is up against treasuries, which they can't lend against. That's like 5% of it. So what they want to do, and it's likely to happen inside, if I were betting, I'd say it happens within a year of us standing here today. What that will do is it will allow the 12 largest banks, or 8 largest banks, which manage about $12 trillion in assets, to buy a couple $100 billion worth of bonds, and it will be every flavor. It'll be treasuries, it'll be, some mortgages. So I think the market starts to see that too. So that's another nugget. I think that's very helpful. And by the way, that's a huge deal for us because the Fed's not buying. One of those Fed officials, Kevin, that you mentioned, Warsh, he has no appetite to buy a mortgage-backed security again. He basically said, I don't want to own these. I want them off our books. So we have to find some other buyers, right? So I think that could be really interesting. That's another good story for us in the mortgage space.
Wow, we'll totally watch it. I think it's interesting we've gone through a period of time where nobody wanted to refinance, nobody wanted to move. And now ICE just came out with their latest report, and they're saying that 1 in 4 borrowers are considering a refi. That's incredible. And then listen to this. So I thought it was incredible. The average borrower on a cash out refinance raised their interest rate 1.5%. So again, people, these are folks who have debt, they have college expense, they're doing a construction project, and some smart LO ran the numbers and figured out that a blended rate, if they're doing a HELOC instead, or keeping the debt load that they have at the interest rates they have, it is better to do a refinance of the entire amount. So make sure you're doing that. And remember, because there is so much chatter, so much. I hear it constantly because I always have my ear to the ground. I'm always listening to listening to different podcasts, etc. And these servicers think they've got it made. They really do. They think they've got your people. They have a relationship, they think. But what I'm finding is a lot of people hate their servicers and would rather chew on glass than have their with them. So stay in touch. That's the other part of this, though, is LOs don't stay in touch with their borrowers. Make sure you are not that person. Make sure that you're letting them know, hey, this is coming down the pike. We may start to see rates moderate, dip a little bit. And Bill, this is my own personal thought. They keep saying, oh, well, if rates were just X, it would be better. If rates were just X, it would just be better. And again, back to ICE, they were saying that at the moment we have like 1 million something loans that are what they call in the money, where if you could refinance right now and they would save money. And if we went down to the next whatever quarter, then it would be like triple that or quadruple that. But my contention is, as an LO who's been doing this for almost 3,000 years, any rate that we hit, they're going to want the next lowest rate. It never freaking matters. So when I was quoting people 2.25, I am not joking, they wanted 1 3/4. So it is just the nature of humans to think or maybe just Americans. I don't know. What do you think?
How many 1 3/4 loans did you do, Audrey?
I didn't lock anyone at 1 3/4, but I was doing loans at 2.
I did one.
It was
15-year VA loan.
That's incredible. I think on the interest rate, you could see, when we go from 2% to 8% on 30-year mortgages, and we've been stubbornly high above, mid to high sixes, above 7 for a long time. I think folks, appetite, we used to hear, oh, it's got to be in the 5s. I think a stable low 6 to 6% interest rate, and like to your point, that the cover comes all. I mean, I agree with your assessment. I didn't realize how many people want to do it. Life wants to go on. That just proved that life wants to go on. Whether there's divorces, people want to move out, kids want to create a family. We need housing stock desperately, and it's really amazing to hear your story about all these folks with different offers. You don't hear that story, nationally. The media is not our friend. The media is not out there to tell us, hey, things are great. Check in tomorrow, Kevin. It's about selling fear, and there's not, there's no shortage of it. They are really good at selling a lot of crap.
That's because her homes are so unaffordable.
Yeah,
that's why there's so many people offering homes prices on it. What was the average price on those homes you were doing?
One was over, and another one was 600, which, so I mean, over $1 million is not cheap. That is not a cheap home. So, I mean, just the property taxes alone, think about it. They're 12 grand a year or something like that. So, and we don't have as high property taxes in California as they do in some states. So,
this state here, it's the worst.
I've heard New Jersey
worse.
Well, Texas is crazy, like crazy. And they don't have Prop 13, which we have, which keeps a lid on them at least. At least when you buy a house, that your property taxes are not going to go up more than 2% a year plus whatever parcel tax is passed or whatever. So Okay.
We just have expensive gas.
Yeah,
That's what
gas is
it is.
crazy. There's really no reason for that. That's insane.
You should see our roads.
I
Bill.
explain it to Audrey all the time. There is a reason why our gas is so expensive. There's too many people on the road already. So by keeping the gas high, it gets fewer people on the road.
And I
So
told
I'm high
you
gas prices.
just go out at 4 o'clock in the afternoons and drive somewhere. That is not working. Okay. So interesting. Another couple things. I'm just going to be Mary Sunshine today. So lending just had its best quarter since 2022 Q2. It is both purchase and cash out. Refis are at 3-year highs. So we are doing better.
Good.
Servicers hit their lowest. I know I just mentioned this, but here's servicers hit lowest retention levels in cash out refinancing Q2, hitting a 4-year low. So again, they are not, and again, if somebody's calling their servicer, there's no way there's strategy occurring in the conversation. I mean, assuming you're not communicating with some bot or somebody who's being paid minimum wage, I mean, you're not getting the greatest minds who are helping you figure out what your next move should be on the biggest transaction of your freaking life. So, uh,
Yep.
anyway, and a third of borrowers are doing cash out refinance. Isn't that interesting?
Wow.
That makes
Yeah.
sense though, because like I have people reaching out to me, they've been delaying putting work onto their houses, and now now I need to do that roof, and while I'm doing the roof, I might as well get the whole house painted, and oh wait, I might as well repair all the dry rot, and then it's like it's the numbers start mounting, and it's like suddenly they need $150,000 worth of work to do, and it's like a home equity line is my best route. Oh, but wait a minute, that rate's at 7.5% or 8%, depending on their circumstances. Well, wait a minute. Why are you bothering keeping that 3.5% mortgage? Why don't we put the two together into a 6% mortgage and you're better off? So,
You definitely have to have that conversation because it varies from person to person. I've got a couple of HELOCs going right now, and one of them, I mean, she has a plan. She's going to pay it off in a few months. She wants to be able to draw it. I went around and around because she has a rental property that's owned free and clear, and I thought, okay. The other thing too is you cannot deduct that interest unless it was a purchase money HELOC. So
Mhm.
how do you calculate that? And Kevin, are you going to go back with those people and figure out how much money they lost in terms of waiting to do the construction while their rate on their first was low, but now lumber has, skyrocketed.
yeah, gone up astronomically. Yeah,
Oh my
yeah, it's
God.
crazy.
It's so complicated and they want to make it simple. They're trying to, so they can scale. Lenders want to scale, right? So that's the word I hear the most. It's starting to irritate the crap out of me because is that good for the borrower? Is that going to serve the borrower and make sure that they get the product, the loan amount, the interest rate that's right for them? Or is it just going to be some bot trying to figure out how to close a loan as fast as possible? Wham, bam, thank you, they there, and move it along. So it is, yeah, it's tricky. The other thing that we're seeing happening, and I think this is happening nationally, Bill, you can comment on this, is that we're hearing like a lot of sellers, they were saying, oh my God, the inventory levels are so high, they're going up so high. Meanwhile, they are still 11% lower nationally than they were pre-pandemic. But also, sellers put their houses on the market to experiment to see if they'd get their price. And now that they're not, some of them, they're pulling them off.
Well,
So they're
mhm.
we're seeing delistings happen. We're starting, I mean, we've talked about that a little bit in other weeks, but it is happening all over the country, I believe. Are you hearing that too, Bill?
Yeah, yep, I am. And even in my own, a data point, even in my own little neighborhood here, some folks have listed their homes. And prior to this moment in time, if you listed a home in our neighborhood, it's sold like this, and it's just not happening now. So clearly they're asking for too much. I don't even know what the prices are, but they're probably asking for something that's gonna have to get a haircut.
Well, and we're seeing that too. We keep talking about this as well. Sorry to repeat ourselves, but whatever. It's good in that the realtors who are seasoned, who know what they're doing, who have the ability to negotiate and have human relationships with someone else, those are the people who are selling their houses. So I had one go into contract in last week, and it was interesting because the sellers had it on the market at 1.8 and they had just lowered it to 1.7. It was just sitting there. My buyers came in and were like, you know what, we're going to go in at 1.5. And I said, that might be a little extreme. Maybe you should try 1.155. instead. So they put an offer in, and you had two really good realtors on that thing, and they were able to settle in the middle and we're in contract and they want to close.
Hey,
It was so funny because they were like, I mean, my buyers want to close yesterday. And they're so excited about this house, and the sellers are thrilled because they want, people who are going to love the house to own the house just like they did for so many years. So when you have good people involved who don't just dig in, to Kevin's point, because I've seen the same thing where, you put in a full price offer and they're like, nope, I want 200 grand more. Okay, that's not our market. And
No.
we have areas around where I live on this side of the bay where there are a group of realtors. They just think that everything should get multiple offers. They should get hundreds of thousands of dollars over the list price. It's a thing. And I'm like, they're so out of touch with what today's market is and what we should be looking at and doing. It's incredible. Incredible.
Well, it speaks to having pros do the deal, right?
Yes.
Yeah.
And okay, I keep saying this, and I know that not everyone agrees with me, but if you're not a professional in this industry, whether you're a mortgage person or a realtor, get out.
Yeah.
It's not a part-time job. It's just not. This is a full-time career. We are professionals, for God's
Both, both sides of that transaction, you think about what they went through to get the deal done, they would be speaking really kindly about both sides. That's what you need.
I know, I agree. Okay, so we have a good comment here from Peter. He's going back to changing the methodology that the BLS is using in their reporting. He says, agree, but you can't arbitrarily change the formula because you don't like it, even if it's wrong, without invalidating any ability to track history or forecast the future. And I think that is valid and true to an extent. I mean, we have to keep it in mind for sure. I still think we should change the way they've been doing things because I think it's
I
whack.
don't know. Yeah, I agree with that, Peter. I agree with your assessment about arbitrarily change because you don't like it. It's more than that.
Right.
And when you're off 90% for a couple of months, and it's been off and off and off, and then there's big backward revisions. And if it was just the jobs report and we're worried about the stock market, that's one thing. But the Federal Reserve is holding rates based on that. Has to change. So what does it look like? I have no idea. But we got to have better data, timely data. Maybe delay it a month. I don't know what it looks like, but we could do better, especially if monetary policies. If it's just the stock market and you want to play the crapshoot and go, with revisions and all that, great. But if we're all relying on lower rates, HELOCs, credit cards, this and that, it's got to change.
But how do we get the market, this, entity of in and of itself that is sort of baseless, but is so important? How do we get the market to understand, look, we're changing things and don't put so much weight into it till we understand it? I don't know. Like there's gonna be a disconnect with that for sure, I would imagine, because there's already a disconnect there. I mean, the fact that the market moves to the degree it does based on a jobs report or an inflation report that we know is probably not accurate. The
Sure.
fact they are moving to the extent that they do tells you that either they're out of touch, they're ignoring it. What is happening there? I can never understand it.
I don't understand. Yeah, it's a great point. And it probably would be great to put like a layer because it all comes out in the wash at some point. I always say the bond market is the smartest person in the room, and I subscribe to that. And that's why sometimes when you get some of these jobs reports, even in the past, there's a reaction. And then you look under the hood. Well, how did we get to the unemployment rate? Oh, 300,000 people left the labor pool. Not exactly really good. So you had a headline number that looked great, but then underneath the hood, all of a sudden people are evaporating. That's not very good. I think the market sorts it out, and there's got to be something better. We're close, but the noise, maybe it was a noise from the pandemic. They got to figure out what it looks like, but they have to deliver something that's more timely and something better because clearly it shakes up our world in a big way.
Okay,
It freezes our clients. It freezes our clients. It freezes the realtors. They don't know what to do. They're like, oh, and then they hear the noise on TV and the political BS associated with it. It's a big distraction.
okay, so we have a comment here from Jason who says that the BLS pick is suggesting that we suspend the monthly jobs report due to the market.
Oh God,
Thought
that's
they don't have a jobs report. I mean, so I've had this argument with economists many times in the past, not so much lately, where I argue, okay, so why don't they just wait until they have accurate data to issue the jobs report? And the economists have said it is then it's old data. And I say, you would rather have crap data than old data? And the answer used to be, yes, we would. They want current information, even though they know it's crap. So if I mean, I don't even know how to wrap my brain around this, except part of me likes it. Part of me gets that you can't do that. I don't know where do we land on that?
Well, I think when it comes to the data, I'm just thinking what it would look like if there was no jobs report. And I'm reminded that every time you turn the TV on, there are economic reports, or I should say, corporate earnings and outlooks created by companies. And what I love, and I made a comment on LinkedIn, there's a lot of economists, quote unquote, out there, Harvard, this economists that tell us that things are going to happen. And then there are people that I think we should all look to for an alternate view. A guy like Ken Langone, he created Home Depot. I like watching people that create and sell shit because they have a real finger on the pulse. If they're hiring, that's a good thing.
Yep.
If firing,
Yep.
that's a bad thing. And the market reacts to that. So the BLS can come out. But if Home Depot said they're laying off 25,000 people, I don't care what the jobs report says. That's bad data point. So
That's
that
bad.
data is
That's
available
bad
to us
mark.
every single day.
Yeah.
Yeah, that's important. Well, I mean, Kevin's at Home Depot about 13 times a week. So
I love it too.
so he would definitely have his finger on the pulse
Yeah, but
there.
it also depends on how much I'm spending at Home Depot. See, there's sometimes when I'm dropping, big dollars at Home Depot, and other times I'm buying, $10 worth of stuff. So it just
Yeah,
depends on my economy also.
So maybe Kevin's just going to Home Depot at that point to get a hot dog from the vendor in the front. Who knows?
I love it. But back to Home Depot, and one of the things for everybody kind of listening, and thank you both for having me. We can't have a good economy without a good housing. They always say housing kind of leads and brings us in and out of recessions. And that Home Depot, you can almost look at that as like a bellwether of our world, because if we're not selling homes, we're not doing the landscaping, we're not doing the
Yep.
siding, all that other stuff. It's funny that I just mentioned that term, but watch what happens there. And, I see better days ahead, but man, there's so much noise. You got to cut through all the noise, try to look, there's so much noise on both sides, try to get in the middle and find out what the heck is going on, and watch the markets, because the markets do tell you what it really thinks. And it tries to stay politically agnostic.
People they need a place to live. I mean, it really just boils down to that. And okay, so we have a great comment from Michael Harris. He says, "You think hiring a professional is expensive? Try hiring an amateur." And I've
Right.
a number of stories like that recently. And by the way, so when I said that HELOC interest is not deductible under the big beautiful bill, I got that information from a listener, Catherine, who is a CPA. So thank you to her for making sure that we understand that completely. It is something to consider. Although you can get so wrapped up in trying not to miss anything. Okay, so here I've got a client who wants to do a little tiny HELOC on their house, but then they have this rental property that's owned free and clear. And then should I do the HELOC on the owner occupied place? They can't deduct the interest there. Or should we encumber you know what I mean? Like you can get so mixed up in
Yep.
what is the right thing for the borrower that you just overcomplicate it too. So at some point you just pull the plug and just, do it. Yeah. So the HELOC thing,
Hey,
yes, Kevin.
real thing before, as we're getting close to the end of the show here, I wanted to bring up the trigger leads bill that was approved last week ago, Saturday.
Right.
And so everyone's like, well, is Trump going to sign it? And it looks like he didn't sign it, but that doesn't mean it's either today or tomorrow that it takes effect, because without a signature, it automatically goes into place. It's not vetoed without a signature. So the triggers lead looks like it goes into place as of tomorrow. And that is huge news for the mortgage world. We've been fighting that. Audrey and I have both gone to the Hill and fought for that. We actually sat down with Nancy Pelosi in her office in the Capitol and met with her and talked to her about it. And so we're like huge fans of that thing going away. But bad news is it won't take place for 6 months. Normally, it's a 90-day waiting period for a bill to take effect, but somehow the evildoers got another 90 days onto that. So 180 days from now before the trigger leads go away.
Why? What a
Okay.
Yeah.
we covered all this last Tuesday, and we got all that information from Jim Neighbors, who we've had on the show, who's the current president for the National Association of Mortgage Brokers or Professionals. We're going to have him back on the show in a few weeks. They really work tirelessly. And I was listening to somebody else from some other association who was talking about this, and they literally had all their facts wrong. So the idea that the bill goes into effect 10 days after it is approved by Congress, that was really important information to know, because I was wondering, like, what happens? What if he doesn't sign it? So unless he vetoes it, it will go into effect. I also have heard some rumblings from people who are like, oh, it's not going to be that great. There are some real cons to this. And so I'm going to listen to that and see what they're talking about, because I'm not sure what the con for the consumer is. And I mean, maybe for the people who are buying these leads, I keep wondering, what are those
Yeah.
companies now? Like, I'm very curious. Yes, they're in trouble, I would think. And then I mean, because they've got this down to a science. Talked to some of these companies, and somebody pulls a mortgage credit, the bureau sells that information immediately, and you literally have seconds to get in touch with that borrower. And the borrowers, statistically speaking, go with the first person they talk to.
Yep.
It is a race, an absolute race. But then I think what tipped it over the edge in Congress, I think I mentioned this last week, was that one of the Congress people had done a transaction and received 2,000 plus hits, as far as people texting, calling, emailing, trying to solicit them. So
My God.
I
You know
know.
what? In retrospect, I bet that LO probably had all his coworkers in the office start calling also the same congressman just to put it over the top.
You know,
Uh,
companies that were buying these trigger leads, they have software. So I mean, you are on. Like, if you are on, like, as an LO, it doesn't matter if your kid is in the ICU, you better have your phone on and be ready to respond to these immediately. So again, back to the I can't believe, Kevin, you called them evildoers, although I can't say I disagree completely. Um, but they did ask for, 3 extra months. They would normally have 90 days, but they're getting 6 months to implement this. And I'm like, please, I mean, anyway, at least it's
Well, it's complicated, Audrey. You have to stop people from making phone calls. You can't just do that overnight.
yeah.
right. Somebody says AI Kevin making the calls. That would be a trip, wouldn't it? Oh my. Um, so anyway, it is, the mortgage industry is so interesting, because we always have something going on, or 5 different things going on. Like, my list to Bill was long. Yeah, I mean, and everything is, there's no cut and dry, easy answer to things. It is
Um,
definitely fluid, and
We
it's
didn't even
something.
talk into details about Fannie and Freddie being sold.
Oh my God, thank you, Kevin. My gosh, thank you. Okay, that's right. Bill,
Take the last 30 seconds.
uh, a couple minutes. We have a couple minutes, or a minute or something. We have a little
So,
IPO. So so it has been suggested that they were going to IPO Fannie and Freddie, and also maybe merge them. So talk us through that. God, thank
well,
thank
you
you.
know, this is complicated. I mean, I think that, there's a government implied backstop. I think they're going to have to figure something like that out. I mean, some of the pros are, we can get the government out of it to some degree, right? A pro. Maybe there'll be a lot of innovation, maybe better innovation, things like that. If it's private, great. But then on the other side, does it make rates increase? What does that look like? The backstop, does it unnerve the bond market if it's a crummy rollout? It can't get rolled out like the tariffs. I mean, just throw shit up in the air. I mean, it can't be like that. It's got to be really solid. I would be optimistic that they get it figured out. I mean, Pulte, that's part of this group. He's no ding dong, but it's going to be something fascinating to watch, and it will affect everybody on this call. I'd
Yeah.
like to think that we get it sorted out. I don't think it's going to happen immediately, but man, there's a lot of moving parts. I have to see more data. And there's so much risk, and it can be so beneficial, but it just has to be done right. It can't be a crummy rollout.
Can you imagine? I'm like, every time I see I'm like, okay. But
I mean, that's a big thing you're touching, right?
oh
It's
my God. But 8 months ago, you would have gone, no. And now you're like, maybe next week could happen. Who the hell knows?
that's exactly right. And the way this administration has gone this year with tariffs and this and that, I mean, Iran, I mean, certain big things happen. Like, no, that's not going to happen. Oh my God, it happened, and we've
It
already.
happened, yeah.
So
Yeah.
I don't know what to make of it, but it's going to be fascinating to watch, and makes everybody in this call worthy, right? Because there will be market opportunities with every one of these stories. So you got to be that real time person providing insights, because it'll be we know we've already talked ad nauseum about the opportunities and people are eager. That will give you another opportunity to go to everybody and be an important piece of insight.
I think it's important that LOs at this point really differentiate themselves from all the other noise by being an expert, offering personal expertise and knowledge about what is beyond the headlines, which is something we focus on every week, and making sure that they stand out because there is business out there. They have to go find it. It's not going to fall out of the sky and whack them in the head, but it's there. So, with all of that, kids, make sure you are out there finding business, finding borrowers who need help because they do need help, they want help, and they really do want you to help them personally, not just push a button, most of them. So with that, Bill, thank you so, so much for today. It was so fun and so informative. We really loved having you on. And to everyone else, have a great week. Go get some loans, lock them in, and get them closed. All right. Mwah. Bye, guys.
Thanks,
Thank you.
Bill.
Thank
Bye,
you.
guys.